Hello and welcome. In this video, we will continue looking at put option contract choices. In the last video, we looked at options with different strike prices that expire the same month. In this video, we will look at options with the same strike price that expire different months. For this example, I'm using SLV, the silver ETF. At the time of making this video, SLV is $19.42 a share. We will look at the $19 put option that expires each contract month. A SLV put option with a $19 strike price locks in the right to sell SLV for 42 cents below the current price of $19.42. This means this option is out of the money. In other words, it has no intrinsic value. The value of this contract comes only from the fact that the price of SLV moves around, in other words, the volatility, and that there's time left for the price of SLV to possibly move down below $19. Let's look at the costs, also called the premiums, for the SLV $19 put option that expires each contract month, and where SLV needs to be for a profitable trade with each contract. The February $19 SLV put costs 57 cents a share. The locked-in sell price, called the option strike price, is $19, and the option costs 57 cents up front. This means for the option trade to be profitable, SLV must drop to $18.43 or below. This contract expires in about 7 weeks, so for this option to be profitable, SLV must drop to $18.43 or below within the next 7 weeks. The March $19 SLV put costs 79 cents a share. The strike price is $19, and the cost is 79 cents. This means for the trade to be profitable, SLV must drop to $18.21 or below. This contract expires in about 11 weeks, so for the option to be profitable, SLV must drop to $18.21 or below within the next 11 weeks. Let's compare the two. The February contract costs 57 cents, and for the trade to be profitable, SLV must drop to $18.43 or below within the next 7 weeks. The March contract costs 79 cents, and for the trade to be profitable, SLV must drop to $18.21. The March contract costs almost 40% more than the February contract, and for this contract to be profitable, SLV needs to drop 22 cents more than the February contract. But the March contract adds an additional month of time for SLV to move. Let's look at other choices. The April $19 put costs 96 cents, meaning SLV needs to drop to $18.04 by the April expiration date. The July $19 put costs $1.42, meaning SLV needs to drop to $17.58 by the July expiration date, which is roughly 6 months away. The July contract costs 2.5 times as much as the February contract, but the July contract expires in 6 months, and the February contract expires in only 7 weeks. The current price of SLV is $19.42, so with the February put, the price has to drop about $1 in 7 weeks, and with the July put, the price has to drop almost $2, but there's 6 months for it to happen. Looking out further, the October put costs $1.74, meaning SLV needs to drop to $17.26 by the October expiration date. And a $19 put expiring next January, which is about a year away, costs $2.05, meaning SLV has to drop to $16.95 within a year for this trade to be profitable. All 6 put options lock in the right to sell SLV for $19, which is below the current price of SLV, meaning that none of these contracts have any intrinsic value. They have a range of prices from 57 cents for the option that expires in 7 weeks, all the way to $2.05 for the option that expires in a year. The difference in price comes only from the fact that the price of SLV moves around, in other words, the volatility, and the fact that there is time left for SLV to move to where the options have intrinsic value. Each day, as the contracts get closer to expiring, the contracts lose money. This is known as time decay. The relationship between the change in time and the price of the option is known as the option's theta. In other words, theta is a measurement of how much the option will change in price when there is a change in the amount of time left until the option expires. We will cover more on theta in later videos. The amount that an option loses in value each day due to time decay is not linear. As an option gets closer to expiring, time decay speeds up. In other words, each day, as an option gets 1 day closer to expiring, the amount of value the option loses each day from time decay increases. For instance, an option that expires in 3 months will lose just 10% of its value from time decay the first month. The second month that triples to losing 30% of its original value, and the final month it loses 60%. An option that expires in 3 months loses 6 times more value from time decay the final month than it loses the first month. So that is looking at other contract months. In the next video, we will continue our discussion on put options with looking at selling a put option to buy stock. I hope you enjoyed this video. Thanks for watching.